The money hitting your bank account on February 1st might look different than you expect, and if you're not paying attention, you could be leaving thousands of dollars on the table this year. Right now, millions of Americans receiving Social Security benefits are discovering that the rules have shifted in ways that directly impact how much they receive, when they receive it, and what they need to do to maximize their monthly payments. The Social Security Administration has rolled out 6 significant rule changes for 2026 that go beyond the standard cost of living adjustment everyone's talking about. These changes affect everything from the earnings test limits if you're still working, to how your benefits are calculated if you're planning to file soon, to new reporting requirements that could delay your payments if you're not prepared. What's concerning is that most people won't hear about these changes until they've already made costly mistakes, like claiming benefits at the wrong time or accidentally triggering penalties they didn't know existed. The February 1st payment is just the beginning of a year, where understanding these new rules could mean the difference between financial stress and financial security in your retirement. Let me start by breaking down exactly what's happening with that February 1st payment, because there's actually more to it than just another check showing up in your account. For most of you watching this, February 1st falls on a Saturday this year, which means the Social Security Administration is going to do what they always do when a payment date lands on a weekend. They'll move it up to the last business day before that weekend. So you're actually going to see that money hit your account on Friday, January 31st. Now, I know that might seem like a small detail, but understanding the payment schedule is crucial because it helps you plan your monthly expenses and avoid any confusion when you're checking your bank account wondering where your money is. The people receiving payments on February 1st are primarily those who fall into specific categories within the Social Security system. If you started receiving benefits before May 1997, you're in this group. Also, if you're receiving both Social Security and Supplemental Security Income, known as SSI, you're also part of this February 1st payment schedule. This is different from people who started receiving benefits after May 1997 because those folks get their payments based on their birth date throughout the month. Understanding which group you fall into matters because it affects not just when you get paid, but also how some of these new rule changes are going to impact you specifically. Now, the amount you're seeing in that February 1st payment is going to reflect the 2.5% cost of living adjustment that kicked in for 2026. I know a lot of people were hoping for a bigger increase, especially after we saw 3.2% last year and those much larger increases in 2022 and 2023 when inflation was running wild. But here's the reality. The COLA is tied directly to inflation numbers, specifically the Consumer Price Index for urban wage earners and clerical workers, and inflation has cooled down considerably compared to where it was a couple years ago. So while 2.5% might feel modest, it actually reflects the current economic conditions we're living in. For someone receiving the average retirement benefit of around $1,907 per month in 2025, this translates to roughly an extra $48 per month, bringing that average up to about $1,955. For couples who are both receiving benefits, you're looking at close to $100 more per month combined, which definitely helps with rising costs, even if it doesn't feel like a fortune. What's really important to understand is that your February payment isn't just about the COLA increase. It's also reflecting any changes to your Medicare Part B premium that gets deducted directly from your Social Security check. For 2026, the standard Medicare Part B premium went up to $185 per month, which is an increase from the $174.70 we saw in 2025. That's about a 1030 increase right there. Now, if you're doing the math in your head, you might be thinking, wait a minute, if my Social Security went up by $48, but my Medicare premium went up by $10.30, my actual net increase is only about $38 per month, and you'd be absolutely right. This is something that catches a lot of people off guard every single year because they hear about the COLA increase in the news, they get excited about that bigger number, and then they see their actual deposit and wonder what happened to the rest of it. The Medicare premium is automatically deducted unless you're paying it separately, so that shrinks your net increase right off the bat. But here's where things get even more interesting, and this is where we need to talk about those 6 major rule changes for 2026, because they're going to affect different people in different ways depending on your situation. The first big change involves the earnings test limit, and this is absolutely critical if you're someone who's receiving Social Security benefits, but you're still working. Maybe you retired early, you're collecting benefits, but you picked up a part-time job, or you're doing consulting work, or you just enjoy staying active in the workforce. The earnings test is this rule that says if you're below your full retirement age and you're earning more than a certain amount, Social Security is going to withhold some of your benefits. Well, for 2026, that earnings limit has gone up. If you're under full retirement age for the entire year, you can now earn up to $23,400 without any reduction in your benefits. That's up from $22,320 in 2025, so we're talking about an extra $1,080 you can earn before the government starts withholding your benefits. Now, once you go over that limit, Social Security withholds $1 in benefits for every $2 you earn above that threshold. So if you earn $25,400, that's $2,000 over the limit, which means they'd withhold $1,000 of your benefits for the year. The calculation changes if you're going to reach full retirement age sometime during 2026. If that's your situation, there's a different higher earnings limit that applies, and for 2026, that number is $62,160 for the months before you reach your full retirement age. That's up from $59,520 in 2025. And the withholding ratio is different too. It's $1 withheld for every $3 you earn over that limit instead of every $2. This is actually much more generous, and it recognizes that you're getting closer to that full retirement age where the earnings test disappears completely. Once you hit your full retirement age, and I mean the actual month you reach it, the earnings test goes away entirely. You can earn $1 million a year, and Social Security won't withhold a single penny of your benefits. But until you reach that magic birthday, these earnings limits matter tremendously, and a lot of people don't realize that going back to work or earning too much can temporarily reduce their Social Security income. The second major rule change for 2026 involves the maximum taxable earnings limit, which is the cap on how much of your income is subject to Social Security taxes. For 2026, this cap has jumped to $176,100, up from $168,600 in 2025. Now, if you're already retired and collecting benefits, you might be thinking this doesn't apply to you, and in terms of paying the tax, you'd be right. But here's why it still matters. This number affects how future benefits are calculated for people who are still working and haven't filed for Social Security yet. Your Social Security benefit amount is based on your highest 35 years of earnings, and those earnings are indexed for inflation. The higher this taxable maximum goes, the more high earners can contribute to the system. But it also means that people who are earning at or above this level are going to see slightly higher future benefits because more of their income is being counted in that calculation. If you've got adult children who are still working, or if you're advising friends or family members about retirement planning, this is a number they need to be aware of because it directly impacts how much Social Security tax comes out of their paycheck and how their future benefits are being calculated right now. The third rule change deals with the retirement earnings test credit, and this is something a lot of people have never even heard of, but it's actually really important if you've had benefits withheld in the past because you were working. When Social Security withholds benefits because you earned too much under the earnings test, that money isn't just gone forever. What happens is that once you reach full retirement age, Social Security recalculates your benefit to give you credit for those months when benefits were withheld. They essentially treat those months as if you hadn't claimed benefits yet, which means your benefit gets adjusted upward permanently. The way this calculation works has some technical changes for 2026 that affect the exact formula they use, and while the changes might seem small on paper, over the course of a 20 or 30-year retirement, we're talking about real money. If you're someone who had benefits withheld in previous years, you want to make sure that when you reach full retirement age, Social Security properly adjusts your benefit to reflect this credit. Sometimes there are administrative errors and benefits don't get adjusted correctly, so it's worth double-checking your benefit statement after you hit full retirement age to make sure the numbers look right. The fourth significant change involves Supplemental Security Income, or SSI, and the asset limits that determine whether someone qualifies for this program. For decades, the asset limits for SSI have been frozen at really low levels, $2,000 for an individual and $3,000 for a couple. These numbers haven't changed since 1989, which is absolutely wild when you think about inflation and how much the cost of living has increased over the past 36 years. Well, for 2026, there's been movement on this front. The limits have been increased to $20,500 for an individual and $3,750 for a couple. Now, I know what you're thinking. Those still seem incredibly low, and you're right, they are. But for people who are living on very fixed, very limited incomes, this change means that they can keep a little bit more in savings without losing their SSI eligibility. It also means that certain types of assets are being excluded from the calculation in ways they weren't before, particularly things like retirement accounts in some cases and certain types of emergency funds. If you or someone you know receives SSI or might qualify for it, this is definitely worth looking into because these threshold changes could mean the difference between qualifying for benefits or being just over the limit and getting nothing. The fifth major change is about how Social Security handles overpayments, and this is something that's been causing absolute nightmares for thousands of people over the past few years. An overpayment happens when Social Security pays you more than you were supposed to receive, often due to administrative errors or changes in your circumstances that didn't get reported properly or weren't processed correctly. In the past, when Social Security discovered an overpayment, they would often demand the entire amount back immediately, and if you couldn't pay it, they'd withhold your entire monthly benefit until the debt was repaid, which could leave people with zero income for months on end. The stories coming out about this have been heartbreaking. People losing their homes, unable to buy groceries, all because of errors that often weren't even their fault. For 2026, Social Security has implemented new policies that make the repayment process much more reasonable. They're now capping how much they can withhold from your monthly benefit at 10% of your payment instead of taking the whole thing. They're also being more flexible about setting up repayment plans, and they're supposed to be better about explaining overpayments and giving people a fair chance to appeal. If you receive a notice about an overpayment, do not ignore it. You have rights, you can request a waiver if you weren't at fault and you can't afford to pay it back, and you can appeal the decision if you believe the overpayment determination is wrong. The sixth and final major rule change involves how Social Security coordinates with other government benefits, particularly for people who receive both Social Security retirement or disability benefits and veterans benefits, or certain types of pension income. There have been updates to how these benefits interact, specifically around offset rules and how certain types of income are counted when determining benefit amounts. For some people, this means their Social Security benefit might be calculated slightly differently if they're also receiving a government pension from work where they didn't pay Social Security taxes. The windfall elimination provision and the government pension offset are two rules that have affected public employees like teachers, firefighters, and police officers in certain states. And while there haven't been wholesale changes to these provisions for 2026, there have been some technical adjustments in how they're applied that could result in small differences in benefit calculations for affected individuals. If you worked in a job where you didn't pay into Social Security, even for just a portion of your career, you need to understand how these rules might reduce your Social Security benefit, and you should be checking whether the 2026 adjustments affect your specific situation. Now, beyond these 6 major rule changes, there are some other things you need to be aware of as we move through 2026. The full retirement age continues to gradually increase for people born in later years. If you were born in 1960 or later, your full retirement age is 67. If you were born between 1955 and 1959, your full retirement age is somewhere between 66 and 4 months and 66 and 10 months, depending on your exact birth year. This matters enormously because claiming benefits before your full retirement age results in a permanent reduction to your monthly payment, while delaying benefits past full retirement age up until age 70 increases your benefit by 8% per year. A lot of people don't realize just how much money they're leaving on the table by claiming early when they could afford to wait, or conversely, how delaying might not make sense for their particular health situation or financial needs. Understanding all of these changes, knowing when your payment is coming, and making sure you're maximizing your benefits requires paying attention to the details. Social Security is probably going to be one of your biggest sources of income in retirement, if not the biggest, so treating it like it doesn't matter or assuming everything will just work out automatically is a mistake that can cost you tens of thousands of dollars over the course of your retirement. Make sure you're checking your Social Security statements regularly, understand what you're entitled to, know the rules that apply to your specific situation, and don't hesitate to contact Social Security directly if something doesn't look right, or if you have questions about how these changes affect you personally.